Welcome to It's the Economy. Banks and NBFCs remain underperformers despite many boosts to consumption coming from the government and the Reserve Bank. To get a closer view of the impact of the GST cuts in particular, and of course the rest of the impulses on the financial sector, I have with me Suresh Ganapathy, Managing Director and Head of Financial Services Research at Macquarie Capital. Good morning, Suresh. Thank you very much indeed for your time. Well, first up, after the GST cuts, we saw Bajaj Auto have its day under the sun, probably for a day or two, and then it's all quiet. How would GST cuts basically impact? Should it not push up retail loans across the board?
Yeah, it should, Latha. I mean, coming from the third quarter onwards, see what's happening here is that so far growth has been tepid, right? And going into the second quarter, also the numbers are not going to be very encouraging. In fact, the bulk of that 50 basis points rate cut, which was done end of June, will flow into the second quarter, thereby affecting earnings. And what we are hearing here is that on the asset quality front, also, I think 2Q will be a tough quarter. Not going to see any kind of a reduction in provision. So near-term earnings remain under pressure. Now it's all a question of hope whether things will recover from 3Q onwards because of GST rate cuts and what could be the implication for the retail loan growth. Near term, there are challenges due to which the stocks aren't necessarily factoring in that kind of optimism.
Would you have any ranking in terms of who benefits from GST cuts?
Largely, for example, all the major private sector banks like the likes of HDFC, ICICI are, of course, heavily involved in the retail segment. Almost 60% of the portfolio comes from retail and therefore they should benefit. Of course, a whole lot of NBFCs, both vehicle finance as well as non-vehicle finance NBFCs like the likes of Bajaj Finance and all should benefit. Stocks have already rallied and pricing in that kind of optimism. So to that extent, maybe one could argue that the current price is more than adequately factoring the optimism coming from GST rate cuts in some of these stocks, I would say. But largely, banks and NBFCs, which cater to the retail segment, are the ones which are going to benefit from the GST rate cut. Basically, those who are there in non-housing portfolio, let's put it that way. Yeah.
Okay. Got that. Retail, non-housing lenders are going to be the beneficiaries. Why are you so negative on Bajaj Finance? Was it that MSME hit that they announced?
Yeah, look, I think our view here is, Latha, both growth and ROA cannot coexist. I mean, if you indeed want to deliver 24-25% growth, say for the next 3 years, 4 years, then you can't deliver at the current 4% plus kind of an ROA that they report. Because growth at the margin will have to come more from secured segments, which will be margin dilutive in nature. And again, credit cost is unlikely to touch the level seen, which we had seen earlier, right? So it will still remain at 200 basis points, kind of an elevated credit cost trajectory. So there is a downward pressure on ROA. And I don't think the current price factors that possible outcome. That's the reason we are a bit more skeptical on BAF. Not that we don't like the fundamentals of the company, but if you have to look at fundamentals in the context of ROA, which could decline and where the valuations are, I think there could be a downside in the near term.
Okay. What you're saying is that they've lent so widely that hereafter extra lending will either come at a higher risk or at a lower return.
Correct.
That's a view on BAF, and so incremental gains are less. Okay, you recently upped Kotak Mahindra. Can you take us through your argument?
Yeah, sure.
You up the target price, right?
No, we haven't. We haven't changed our view on the name. It still remains neutral. But what we are telling here is that 1Q was exceptionally bad, driven by margin compressions and credit cost, which of course really disappointed the street. We do believe at the margin, some of these pain points could abate. It's not that it's going to come down very significantly, but at least there is going to be sequential improvement. Note that they also cut the savings rate, but bulk of that happened towards the end of the quarter, and therefore the full impact of that savings rate cut will flow into the flow from second quarter onwards. To that extent, their margin performance should be relatively better. And there is an acknowledgement of some of the issues which are facing them, and therefore the bank is on a course correction mode. Now, some of these things will take 2, 3, 4 years for it to get shown in the numbers, but near term, at least there is a sequential tailwind coming to the stock, and therefore it remains a good tactical outperform in the near term. We do have a neutral perform over the medium term on the stock.
Yeah, I noticed it was neutral. but I thought the price had been upped. Okay, let me come to the very interesting report you wrote around the time when the bank results came out, saying that the best result award goes to City Union Bank. Is that still one of your best buys?
I mean, and the mid-cap one, yes, and they will also be big beneficiaries of all these rate cuts, which will eventually, GST cuts, which will eventually have a positive effect on the SME space. They have a very large exposure. Also note that Lata, they are the only ones in the system which has 99% of the portfolio secured. And today, there's a greater degree of challenge, as you know, on the unsecured portfolio, but things are still not completely out of the woods. Let's put it that way. So to that extent, they are relatively in a better position, even when it comes to the asset quality. And for a couple of years, their growth was also relatively weak. Because they were going through their own internal structuring and restructuring, and today the base is comfortable enough for them to grow. So all those things work in their favor. Valuations are also relatively reasonable in the current environment, and therefore CUBK still remains a decent pick for us. And I think some of the export incentives which are being talked about by the government on the SME space, again, CUBK having 50% of the exposure to the SME space will also benefit in case the government, of course, decides to tackle on the tariff issue and implements some of those things that they've been talking about.
Okay, the other thing that we keep getting from bankers is that the worst pain of MFI is over.
Yeah.
If that is the case, are you turning positive on IndusInd or Bandhan? I mean, IndusInd has fallen enough for all the troubles it went through. So, and also MFI portfolio for both these banks, on the cusp of something better there?
Yeah. See, Bandhan, we already have a positive view, and we do
Okay.
believe
Okay.
second half will be better. The only joker in the pack is BR elections, Lata, because sometimes around these elections, something or the other happens, and therefore we have to be a little bit more guarded about our base case view of credit costs coming down in the in the MF5 space is also contingent on no untoward activity happening, say in Bihar. And of course, remember, West Bengal also goes for elections in April of next year, right? So we
Yes.
have to be a little bit more careful around the election times, and these are all even risks. It's very difficult to predict. Notwithstanding any of these election related issues, at least the MFI sector should see across the board a reduction in credit cost. And note that since the start of the year itself, a lot of people have started implementing the three lender rule. Some of the benefits of that should start flowing into the overall economy in terms of reduced slippages and credit costs, right? With a greater degree of discipline
Yes.
emerging. Now, IIB is a little bit more different because I think you have to look at the fact that while there could be tailwinds in the MFI space, I mean, I think the path towards 1% ROA is very arduous. They will have their own set of challenges. A lot of management related changes will happen, and that path towards 1% ROA being difficult and longer term and fraught with its own set of challenges means that risk reward, even now at the current price, is unfavorable, and we will be a little bit more skeptical, and therefore it remains an underperform for us.
Okay. Okay, still, I guess Rajiv Anand will have to show some mettle.
Yes.
Let's come to the other GST category, which is much discussed and in which you have hardly, you don't have too many buys, the insurance sector. You're surprisingly having a outperform on LIC, where your earnings CAGR is only 9%. And you have an underperform on HDFC Life, where the earnings CAGR for 3-4 years is actually 16%.
Yeah.
Is it that it is too expensive? Is that why HDFC Life is a sell,
I mean, look,
but LIC is a buy?
yeah, look, I think Latam, when you're getting 15% VNB CAGR, the market is paying 20 times VNB multiple, whereas the VNB multiple for LIC is negative because it trades below EV, right? I mean, so there is a valuation discrepancy, point number one. Second thing, we do believe that the RBI's regulations on third-party mis-selling of products on the banca front will come through in due course of time, and that will affect definitely people who have a larger degree of dependence on banca. LIC has the least dependence on banca. There are also LIC benefits. So there are some near-term things which are working in LIC's favor, due to which we have an outperform in LIC. I do believe that because of the GST, there will be some marginal impact on the VNB in the near term. First half has been a challenge in general because of the base effect of last year. So all these pieces of puzzle, if we were to put together, we're looking at a relatively a modest year for FY26 when it comes to the insurance space. And that is the reason where the valuations are. We are relatively a little bit more guarded for the life insurance space. And we have a bias towards a low valuation entity that like LIC. And of course, we are waiting for the RBI regulations and the bank front, which will have some impact on the life insurance players.
Okay. I guess Reserve Bank is also holding back since, everyone wants consumption to pick up.
Yeah.
Well, actually running out of time. Very quickly, you don't like any of the fintechs?
Yeah, look, I think PB Fintech is the only player which we do like because at the end of the day, we do believe that if there is going to be more number of players, as you have seen entering into the life insurance space, if the banca thing goes through, then obviously there will be greater degree of a dependence or sales happening through the PB Fintech channel. Overall, I think the GST cuts are good from a demand perspective, both on the life as well as general insurance over the medium term. It may not happen immediately next quarter or so, all that will benefit a broker like a PB Fintech. So PB Fintech is a better play in my opinion. And of course, even the Insurance Amendment Act, which talks about the composite licensing regime, that should benefit a broker like PB Fintech better compared to some of the other channels, I would say.
Okay. I'm absolutely being warned. If you can give a one-line answer for this. The positive on banks seems to be that now that MCL and our deposits and all will start repricing.
Yes.
So margins should have bottomed. But on the other hand, the negative we hear is this, are MSMEs now becoming a problem?
Yeah.
Where are you on that? As briefly as you can.
See, first to begin with, Latha, we have done extensive checks, and what we have realized here is that the large banks, when it comes to their MSME portfolio, be it the likes of HDFC and ICICI, are doing very well. I mean, there is not even an iota of stress that they are seeing. Of course, there will be some recalibration of portfolio with respect to MSMEs in the textile space, but they are really fine. So, what's happening in the MSME space is the stress currently is visible in the unsecured and also, of course, on the lower ticket size. The larger ticket size, which is greater than a crore plus, MSMEs are still doing very well. And I think that situation is at least unlikely to change. So we have to be a little bit more selective there when it comes to MSME stress. The tricky part with respect to the overall banking space here is I still believe market is not pricing in a rate cut happening in the October to December quarter. Because if that indeed goes through, and I don't know, it's your guess, anybody's guess whether it can be 25, 50, maybe they don't do. But if at all they indeed do 25 to 50 basis points, GST cut will also result in lower inflation by 25 basis points, as per some economists, thereby opening a little bit more amount of leeway in the near term. Then there is going to be a shift of the entire margin recovery. So what you thought would happen in 3Q and 4Q will now get pushed to 1Q of next year. And that I don't think the market is pricing in.
Oh, absolutely. And we haven't even spoken about the fact that the bond book has crashed.
Correct.
Other income is going to be less. Thank you very much, Suresh. Pleasure speaking with you, giving us a 360-degree perspective. We have to wrap up on Bazaar on that note. Chartbusters up next.